Now let's look at investment strategy during expansionary periods. During the normal course of the business cycle, our economy will go into a period of recession. Now, what is a recession? It's a general slowdown in the economy. It's characterized by high levels of unemployment, lower consumer spending, and lower business investment and spending. And that's why you end up with higher rates of unemployment. Because if consumers are not spending and business does not have the money or the earnings to spend because they're not making any money from the consumers, then you have to lay off workers. When unemployment starts to increase to levels that are unsustainable for the economy, and usually we say that's upwards of 7-8% or more, the national government will step in to try to spur economic growth and take our economy into an expansionary stage. Now, there are two types of expansionary policies. You have monetary policy and fiscal policy. Now, let's first look at monetary policy. Monetary policy is executed by the Federal Reserve, our national central bank. It's an independent bank, independent from the political arms of the President, the Congress, and the Supreme Court. Federal Reserve, for short, is called the Fed. Now, the Fed has many tools that it can use to take our economy, spur it into growth or an expansionary stage. One tool that it uses the most often is the manipulation of interest rates. And again, interest rates, the cost that it takes to borrow money. It's the cost of money. So what the Fed wants to do to take the country into an expansionary phase, it wants to increase the supply of money. So by lowering interest rates or the cost of money, you end up increasing the supply of money. And when you increase the supply of money, that adds further deflation of the cost of money or the lowering of interest rates, which expands credit. Expands credit, makes it easier for consumers to get loans, to make purchases, and it also lowers the cost for businesses to loan money for investment and thereby hiring workers back. More consumer spending because there's been an expansion in credit means we'll be able to hire more workers. That's monetary policy. Now, the political side of our national government, in particular the President and Congress, wanting to spur the economy into growth or expansion, will undertake what we call fiscal policy. Again, you want more money in consumers' hands. You want more money in the hands of business to hire people, to invest, for consumers to spend. So what the federal government will do, the President and Congress, they will pass legislation, fiscal policy, economic policy, that will lower taxes, meaning businesses will keep more of their money to invest and spend. Consumers also will keep more of their money to spend. So you have more spending, more pent-up demand. Expansionary policies will also involve increasing government spending. The government may go on a campaign or a policy to spend more money on building up the national infrastructure like roads and ports and airports. That again is to pump more money into the economy so the economy can go into an expansionary phase. We can get more people off the unemployment rolls and into employed positions in the economy. Now, as an investor, there are two strategies. You have a conservative strategy and an aggressive strategy when you sense that the Fed and the federal government are going into expansionary policies. Now let's look at the conservative strategy. In a conservative strategy, the investor may want to focus primarily on convertible securities and common stocks with a low beta. An aggressive investor strategy will involve common stocks with a lower dividend, but because of this expansionary policy, more money coming into the market also to buy stock, common stocks with low dividends, and again, a dividend is the amount of money that a corporation will pay its investors during a period of time for holding their stock. Well, what some companies will do is pay a low dividend or no dividend at all and just take their earnings that they make. Instead of paying a dividend to investors, they will reinvest those earnings into the company, making the company more wealthier, more valuable. Well, a investor that's taking an aggressive strategy invest in common stocks with low dividend payments or no dividend at all and hope to see more return or capital gain in the stocks that they own because of the increasing price of the stock. Again, because it's an expansionary stage, because of the Fed and the national government, this increased money coming into the market, buying stocks, will increase the price of stocks and definitely increase the price of common stocks that do not have a dividend or pay a low dividend.